Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, you're kind of curious about the whole multifamily investing just concept, you're in the right spot because every single week on the Gray Report, we are taking a deep dive into all the latest research, data points, market trends, covering the multifamily industry, real estate, and the economy. So you want to make sure that you're subscribed to the Gray Capital YouTube channel so you can continue to receive weekly updates. We're going to be breaking into it. Reports from MSCI, Fannie Mae, Freddie Mac. A lot to cover today. Let's get into it. All right, welcome back to the Gray Report. Very exciting episode. We've got a guest host today, Addison Lubert. He's a senior analyst over here at Gray Capital. Matt Bosnagel, unfortunately, is out on medical leave today. I don't know if anyone else has been experiencing this. Just from anecdotes, I believe it. So it just seems like everybody's been sick recently. I've been sick. Alex was sick. My kids were sick. Andrew's kids were sick. Jay's kids were sick. Have you been sick, Addison?
I've not.
That's good. Matt's sick.
Yeah, I'm kind of thinking it's best to maybe stay where I'm at because I've through timing wise kind of dodged everything.
Yeah.
So
yeah, it's good. Is that a HIPAA violation? Can we not talk about Matt being sick? It is what it is, right?
If we get a note from his lawyers.
Matt, feel better. Get better soon. Hope to see you back on the Gray Report next week. Addison, you're jumping in here last minute. You're filling an important role, big shoes to fill, but we're glad to have you here because your full-time job is you're analyzing real estate. You're looking at deals, deal flow. You started at Gray Capital, about a year and a half ago or so? Two years ago?
Last June.
June of
2021.
June of 2021. Time flies.
It does.
Came on full-time analyst, looking at all kinds of deals. You saw the market as crazy it was in 2021. You've seen a big shift the past couple months, and we all have.
Yeah.
What's the difference between deals last year and deals today?
I would say kind of the starting point was in 2021. Deals were, in terms of valuation, stuff like that, I don't want to say valuations really ran away. It was more so you could value a property and based on a cap rate or whisper price or any sort of metric you want to use, it wasn't really out of control. It was more so just what are your returns and whether you can do the deal or not is based on just looking at returns. Whereas how crazy the interest rate environment has been this year, I would say that it's more so changed to what kind of pricing you can even achieve or be available to do through debt.
Yeah.
And so there's been a lot of times where just having kind of tough conversations with brokers or, trying to move some things around expense wise or maybe see where there's some hidden value levers within a property. It's more so become what can we pay through debt, not, I shouldn't say stop caring what the property is worth, but the whisper price is more focused on what people can even pay. Yeah.
Because if all the valuations were based on a buyer getting 75% loan to value and paying a 3.5, 4% interest rate, and you could count on that, that variable was pretty consistent and kind of the same across the board. But it seemed like there was a long period, longer than it should have been, of when broker would come out and the assumptions were made. Their BOV was put together when interest rates were 3 and 4%. Yeah. And they put their offering memorandum together when interest rates are 3 and 4%, and they send it out and interest rates are 5, 6%. And, they were quoting getting, full leverage. Now it's no, we're only getting 60% leverage in our rates, in the mid fives. Mm-hmm. And so there's a big gap there. And it almost seemed like a lot of brokers didn't want to believe it, even though they knew it to be true because they're talking to lenders all the time for their own underwriting and their own deals. Yep. What was that like talking to brokers who kind of had an idea on pricing because they've told the seller, who's their client, what they're going to try to get for them, and they don't want to let down that seller? But what's it like having a conversation with a broker where they're just not living in the same universe same planet as we are.
I don't necessarily know if there's ever been a conversation with a broker where they're not in the same universe. I think it's almost just kind of a, almost, I don't want to say like a positive mindset, but kind of okay, but like if we really believe or kind of keep the forward facing attitude that like the 15 million we wanted is going to come around at some point.
Somebody's going to be out there.
Right. And
doesn't hurt to ask, I guess.
I'd say there's a lot of times where the brokers and kind of the initial pricing feedback, just on phone calls and stuff like that, they'll initially be a bit bummed or kind of give you the, okay, well, good to know, but yes, we can count on you not putting in an offer. Yeah. It's not until...
That's a nice way to say.
And I think it's not until probably they have 4 or 5 other phone calls where they realize, oh, okay, that's where pricing's going to shake out at.
Yeah. So the longest time it was, well, let's throw a high number out there, but then the prices it's going to go over whisper. Mm-hmm. It's going to, by millions of dollars, by 10+%, and so they went from being like, oh, let's pick a high number, see if anybody bites, and then not only people bite, but people bid it up, to now we can't even get close to the number that we want.
If there's a best way to describe the difference between last year and this year is I felt like last year the market was really driving the prices and like just kind of the insane amounts of debt people could get. So you could have a whisper price and people would push over it. This year, I feel like it's really the lenders that have kind of set what pricing's going to be just because everyone has a hard constraint. Yeah. And, like I said earlier, it just kind of comes of, I don't care if it's worth $45 million in your guys' eyes. I can't pay more than 30 because I can't get the debt on it. Yeah.
Yeah. It's just the reality. And something I was thinking about is that, we've talked a lot in the past about the correlation between interest rates and cap rates. And there's been a decent amount of data out there that was suggesting that not necessarily that strong of a correlation between cap rates and interest rates, at least the 10-year treasury. But what it seems like, there's no way that they can't be somewhat correlated because it's the cost of borrowing, it's the cost of capital. But it seems like the last decade or two, the movement in interest rates has been subtle enough while the demand for apartments on the kind of the investor side has increased, that a tick up in interest rates didn't move the needle enough to bring cap rates up as well. And that and maybe cap rates would have lowered more, like back in 2018, 2019, when interest rates were increasing, cap rates basically stayed the same. Maybe they would have lowered a little bit more if they were lower, but you didn't see a lockstep, okay, interest rates are going to go up, however many basis points, cap rates are going to go up as well. But it seems like there's a threshold, like a gate of when you cross a certain boundary that all of a sudden they become so out of whack, cap rates and interest rates, of where it starts affecting your ability to get the type of leverage. Because in the past, you'd still be able to get your 70, 75%, up to 80% loan to value. But then they've moved to a degree, cap rates are still low or were still low. And then all of a sudden you can't get 60% loan LTV, your returns go down, you have to bring up on so much more equity. Buyers, they can't afford to speculate on a lot of rent growth because just the check that they have to write is so large. And that's finally bringing cap rates up into levels where they're approaching levels where deals may start to make sense.
And I think what also kind of ties into it is, now, I guess my commentary on this would have to be taken with a grain of salt because I was in the middle of college when this was going on. But in 2018 and 2019, when interest rates were going up, I don't remember hearing or reading really any speculation of they're going to have to hike it up even more.
Yeah.
They don't know if this is going to stop the economy. I mean, it seemed like there's a lot of confidence in the economy. Whereas in this cycle, they have to raise interest rates just to, for the usual item of taming inflation. But there's so many other factors going on, fueling inflation, fueling other stuff going on, as opposed to just a basic U.S. recession.
Yeah.
On top of, we're having to raise the interest rates incredibly high. We don't know if it's going to continue to go on. And, I mean, it's been probably since, March or April of this?
Yeah.
And now we're into the talk of we're in a recession or we're going to hit a recession.
Yeah.
It could get worse next year.
And like the certainty of that, of we're definitely going to a recession. And there was like a little bit there was recession talk back in like 2018, 2019, but it was because like the yield curve inverted. But the conversation was much more about how just like we were due for one. Things had been really good, and okay, cycles should still exist, and this is the longest run cycle, and we should be. We're just due for one. It shouldn't be horrible, but like okay, it's time for the pendulum to swing the other way. Whereas this is like, oh, this is like an emergency. This is a crisis. We don't really understand it. We don't know kind of what gravity, even is anymore. And some of it is just because like we're returning to economic principles actually like mattering. Like, oh, okay, so these cycles like do exist because we went 12 plus years of just one bull run and everything was just going up and up and up. And, low interest rates and pretty loose monetary policy and without much inflation. Now we're all of a sudden seeing all of these counter forces kind of come back to play. And so on one hand, where things are working sort of the way they should be working, but it's just really, really messy, and people couldn't be more pessimistic as they are right now.
I really wonder I don't know if it would be, I guess, my generation or people my age, as we continue to kind of progress through our careers. I think a lot of us, our probably first early memory of a big issue happening was the financial crisis.
Yeah.
Either having direct family members affected by it or, kind of extended family. And then the last 2 years with COVID, and then the kind of inflation correction, stuff like that.
Yeah.
That I wonder if 10 years down the line, if we just have a normal, as you said, what could have happened in 2018, 2019 of a recession that's just a cycle.
Yeah.
I kind of wonder if people my age are going to be like, all right.
Yeah. Like just normal.
Yeah.
Like, yeah, born in crisis and just lived in crisis. And
like, let me know when there's like a massive stock market crash, and then I'll maybe be concerned about this, but I don't know. Cause I feel like the only two that I can come to memory from me are 2009 and then the last 2 years. So
yeah. I mean, the recession before that, 2001, that was, you were too young to care about.
I was too, yeah.
Yeah. You weren't following macroeconomics.
I was midway through Rich Dad Poor Dad at that point.
Nice. So I other than like I was in middle school I was in middle school, and I remember it was more 9/11 was still a bigger deal, and then it's like we were in a recession, but it was in middle school, and it was like, oh well, we got the World Trade Centers got blown up, so we're in a recession. For some reason that seemed to make sense, but I don't know at the time. Fascinating. Well, let's take a look at some of these reports. We've got some interesting pieces. We're not going into too many, but some really good stuff that to me answer some questions I hear thrown out a lot, or some speculation, and part of it also is just to kind of see where we are in November of 2022, closing out the year, and again, just people are uncertain. They just don't want to make decisions right now, which I understand, but I do think it's going to be a pretty great opportunity because of that. So let's take this first, just macro view. We got some property price information from MSCI. U.S. property prices fell in October from September. No one likes to hear that, but it's, again, not too surprising as we covered this on the Gray Report in the past. We're going through a complete global, repricing of, all assets. Look at the tech industry, stock market, crypto. Everyone's trying to figure out what things are worth. And with the run in commercial real estate over the last couple of years, like many other assets, it's not too surprising. So let's take a look. The RCA CPPI All Property Index. That's a lot of letters, but it's certainly down. We saw this huge surge at the end of 2021, early 22, and then basically like in lockstep, as Jay Powell started to crank up the Fed funds rate, we saw those prices come down. But then breaking it down to different sectors, different asset classes within commercial real estate. Industrial is faring the best by far. There's a lot of tailwinds that have been driving industrial. Addis, I know you're a big fan of the industrial asset class, as you should be. It's doing really well. Still seeing price declines, but out of all these other asset classes, industrial is still doing the best. Looking kind of, I think it's right at 18%, growth, which is really, really strong. Apartments come in at number 2. I mean, they peaked similarly to industrial, but have come off the really strong gains that were almost at 25% price growth. Now we're kind of right around like 11% at the end of 2022. Now, for the last 3, office CBDs, this is downtown offices, kind of just like a little bit more of a boring chart there, if I do say so myself. We saw the big declines declines in 21, some modest price appreciation, kind of 7%, peaking, halfway through 2022. And then we're not down at 0, but certainly not a lot of growth. Suburban office doing much better, though. Had some nice 15% growth that peaked at the end of 2021, and it's kind of sliding back down, unfortunately. But people moving to the suburbs, definitely a migration story there, so that makes sense. It seems like an office in general, the new offices that have either newly constructed, newly renovated, have all the amenities, they're doing really well. Older Class B office that just, not doing well. Yeah. Not too much interest. A lot of questions in general. I mean, they haven't been answered of just what is the future of offices? What do they look like? I don't think it's going to be as drastically different. Maybe some people think, but who knows? I don't know. You have an opinion on that, Addison? What do you think? What's the office going to look like? Should we redo all this?
I mean, I think our specific office is kind of, I'd say, the way a lot of modern offices are going, in terms of new construction, everything like that. But I'd say for the overall industry or kind of market sector of office, I kind of tend to think that that's one is going through a major, I shouldn't say major correction, but I think that's what it's undergoing.
Yeah.
I think there's a lot of people that got really comfortable in 2020 or 2021 with working from home.
Yeah.
And there's going to be some people that see the challenges with it. I know it's kind of more of an anecdotal side of things, but plenty of my parents' coworkers that when they made the shift that weren't already working from home thought it was great until they can't get away from their kids. They don't have quiet time. They don't kind of have that block of, I go here from 9 to 5, and then when I'm at home, it's an entirely different environment. I feel like I've moved around. I've done something for the day.
Yeah.
I mean, I can understand that aspect of it. It allows you to kind of, if you're a fully remote company or majority remote, you have a larger talent pool that you can pick from with employees. You can have someone working in Kansas City. But I think there's a lot of people over time that are going to reach the point of it's nice to get out or
have a place to go.
Yeah.
I agree. And I mean, I guess the one thing that seems less certain, and I haven't seen much pushback, is that the solution is some sort of hybrid and more flexible just policies of where, just like you said, there are some days where it's going to make sense to work from home and that you can get more things done at home. I mean, there's certain days that, all right, I'm going to work from home. I can focus and actually get work done. I'm only coming into the office. I'm talking to people, checking in on everybody, and I'm not getting as much of my work done. But then I know if I work at home all the time, then all of a sudden there's other distractions at home with the kids or whatever else is going on. Some days I want to be here. Some days it's like I just really need to be at home, and not being like a binary choice. But then the question becomes, all right, so if not, what percentage of the workforce is at the office, and do you need a permanent place, or is it more of, are we in the office to collaborate? Do we need less offices and more, collaboration space? And does that mean more or less square footage? And again, that's what we don't know.
I also wonder how much of that stuff is in substitution of just a bad, I don't want to say bad office policy, but now becoming a flexible, like if your water tank, something happened to your water tank and you need the repairman to come over, like you can work from home that day. You don't have to take a day off, or you don't have to rearrange family schedules to take care of it.
Yeah.
I wonder if more of that stuff is kind of encouraging that you're not forced to be in the office. You're not forced to be at home. Companies are now being flexible, that nothing is feeling forced. I don't know if that's going to build more of an attitude of, okay, it's nice to go to an office knowing that if there is a Friday that I need to be at home, I'm okay with that.
Yeah. It's interesting in some of the industries, like the tech sector, tech industries that were the most remote friendly and were like completely remote. There's been some kind of reversing of that trend from kind of the CEO and the C-suite of really pushing people to come back, into the office. And I think the whole Twitter is the most recent and biggest example of we need people in the office, and Elon Musk laying out all the reasons why they want people in the office. But it's also companies like Apple as well that are saying we just think the best work gets done when people are together in the same place. And really, I think trying to and again, I don't think they're saying that you have to be in the office all the time, but having a central place to meet does have value as well, and it can't be ignored and just tossed out and complete the end of the office.
What's kind of cracked me up about the return to office kind of movement was it seemed like a lot of the big companies, I guess you could use Twitter as an example, but I'm thinking more so the firms that are on Wall Street.
Yeah.
It seemed like there was public pressure, or they felt that there was going to be public pressure on them of like, okay, sure, it's time to return to the office, but...
Well, they're like, let's move the office to Florida.
Well, yeah, that as well.
They're like, why don't we just move? Why don't we just all move to Florida and hang out in the sun? Maybe we can go in the office.
I think they were like worried about public pressure of like, they're being reckless or whatever, going back to going back to work in person, and it's like I can't imagine anyone would really have an issue with that.
Yeah.
Like, I can't believe they're doing that. They're being, JP Morgan is out of hand. Or,
yeah.
They're out of line doing that.
Yeah. It's interesting though, because COVID did, and when everyone was working from home, it did expose the fact that an office is maybe more of a luxury than a necessity. That like you can work, you can get things done remotely. Mm-hmm. And so it's a calculation of, how important is that luxury and how important is the in-person collaboration. And I think maybe newer businesses that are starting up maybe will have more of a remote culture rather than an in-person culture. But I don't know. We'll see. I think it's what do you want your company to look like and what type of culture you want to have kind of at the end of the day.
I also wonder what, and kind of, I guess, the best way to know is talk to bosses or owners of companies that flipped either way. Is it easier to go from being in person to remote, or going back to remote? If there's any aspect of it that's like once you go to that route, you can't go back.
Yeah. I just keep hearing about people who have started jobs remotely and like they've never met any of their colleagues.
Yeah.
And I hear from older just people who are more senior that what you're certainly going to miss out at some of these big firms is like that lack of mentorship of someone coming in, they've graduated from college, and in the past it's like there'd be some senior level people who they'd be working with and they kind of mentor, show them the ropes, and this is what we do with the company. And not that you can't do that remotely, but it's just a little bit harder to do that, because again, it's like you have to schedule a Zoom call or Google Meet or whatever. To like, hey, let's have some small talk about just some not that important stuff in the office, but stuff you should know, versus like, hey, we're bumped into you because we're both grabbing a drink from the refrigerator and what's going on, and give you a little bit of wisdom. And so that stuff just never is going to get translated down remotely, or just that much more difficult.
I also don't think if you're working from home, like there's a strong case that work doesn't really ever stop. And you kind of think of family members or family friends that from the suburbs I'm from had a good 45-minute to an hour-long train ride into Chicago, where, all right, from 8 to 9, I can't be reached because I either don't get cell service on the train, or I don't have access to, I have access to a computer, but I don't have access to the internet.
Yeah.
Whereas you're at home now, people are always...
You're still there.
Stuff.
Finding the boundaries, it makes it blurs all the boundaries between work and home. Like, you're working from home, but you need to take care of your kids, or do something, let somebody in, fix something. But then it's like, well, when do you win, and how do you turn it off, and where are those lines? And then there's also just a debate in general of, what should be, and this is much more of it's a business by business culture, but just like an American work ethic and work culture thing as well, of where like in Europe, it would be, in most European countries, it would kind of be crazy to think that you're going to like keep working past 5 and take calls and answer emails and do some work on Saturday and put in all of these extra hours.
Yeah.
It's much more of like, I'm here, I do my job, and then I have a break where I'm not going to do any work, and I'm going to have lunch, and I'm not going to do any work, and then I'm going to get off, and I'm not doing any work, and then I'm going to go on like my mandated month long vacation or whatever.
Yeah.
Which that's Europe's a cool place. People could do that, and that sounds fun. But then here in the United States, it's like, well, no, we want to work as hard as we can. We got some extra hours in the day. I mean, how many influencers are financial influencers or whoever are saying, you got 24 hours in a day, and you're working 9 to 5. But then what are you doing the other hours? And you've got 4, 5, 6 hours a night. You could be getting work done. And what do you mean you're not working on Saturday? You're not putting a couple hours in on Sunday. And if you're not, you're not a hard worker, and you don't deserve any type of success, and you're scum.
The competition that you don't know about is doing
someone else could be working.
Thing, yeah.
And I think that there's, on one hand, you have to have balance. Like we had Blake in here a month or two ago, and we were talking. I was like, how do you win these gold medals, and what's the difference between you and other people? And the biggest difference is I knew when to stop and to rest and to take a break. Mm-hmm. And because everybody's good at a certain level, everybody's working hard, but some people get burned out and you lose your focus. And so you have to have some sort of perspective. But it's just interesting, again, it's an American culture of, is it wrong to overwork? But at the same time, it takes overworking and going beyond what other people are willing to do to achieve results that are, in excess of what the average is. Mm. And how do you tell someone is it wrong to tell someone like, you're passionate about this, stop, working on it? Or is it, again, American culture all about, money and building wealth and all of that, and just focused on money and success? I think there's a balance in all of that, but it's interesting to think about. And I think this working from home, working in the office, all plays into that discussion of what should American work ethic and culture can be like. I don't know from you're from the Generation Z, technically, correct?
I think so, yeah. I'm from Generation Z, but when older people have complaints with kids my age, I get thrown to the millennial crowd.
Yeah,
so
yeah. You don't come off as a, not that there's a typical anything, but I don't know, a typical. I feel like I have to give you some of the insights into what the kids are doing these days every once in a while. Not really, but I'm just curious, your thoughts on, that American kind of work culture, and where is the line? What's the proper balance? And not that like you're talking to your boss and I'm like, should you work hard or should you not? Take that out of it.
I would say, the biggest difference is, I kind of have an interest, or I'm at an interesting point in that, I'm finally done with school.
Yeah.
And so now I'm at the point where I can kind of look back on, what was I taught in junior high, high school, college, what's been useful, what hasn't been useful. Mm-hmm. And going to what Blake had mentioned about knowing when to stop. I think one thing that kind of gets lost in the shuffle is, kindergarten through college or kindergarten through 12th grade, you get a break. You have a summer. Mm-hmm. Yeah. And I was, played basketball pretty much my entire life. Even when I was playing summer travel basketball, the school basketball season was November through March. Then there was a little bit of a break there. Then you went to travel, and then you'd have breaks in between there. But there was still an off season in between things.
Yeah.
And I think there's enough of a mental psyche that there's been a few years where it's like, I just need this season to end because I'm just in a funk or whatever. Yeah. And a guaranteed 2 weeks off of not playing or just not playing in any games is going to make a difference. And I kind of wonder if that benefits the work culture in Europe more of like, you have to take a month off.
Yeah. And everybody's going to rest and recharge and get back to it.
Right.
Yeah.
And I don't know. I think Andrew was saying the other day that there was like mandated PTO rules on like, if you're working McDonald's at 40 hours a week, like they have to give you 7 days. But I don't know. I kind of wonder more so if it's those lack of breaks that really change anything, or the lack of breaks have any issues for for folks?
I think it probably does. I mean, without it being able to take a step back and thinking about it, it's hard to kind of get a good perspective on what your next steps are and plan and, set goals. And it's hard to see the forest through the trees when you're just in the thick of it every single day. And you're just trying to survive and stay on top of it and get through the today and the next day, not be like, all right, hey, how should I think about, where I am, where we're going, and what steps do I need to take to get wherever I want to go? You just don't have that time.
The other thing the other lesson that I kind of try and keep in mind is, kind of reading about different athletes or different kind of like presidential biographies. You hear of, I don't know what generation that would be, but like Lyndon Johnson, Reagan, Carter, a lot of those guys like grew up on farms or grew up in areas where they're really good at certain activities because that's what just kids in the area did.
Yeah.
But then had to work like long hours on the farm because instead of hired help, them and their siblings were hired help.
Yeah.
And so you hear enough of those stories, you're like, well, they didn't have a break and they went on to do some pretty cool things.
Yeah.
So, and I feel like there's kind of that mixture of
they had all winter.
Yeah.
They had all winter. They had done all their canning and then they sat inside all winter and survived.
Well, and so I think there's I don't know if it's the internet, social media, whatever. I think there's a weird situation going on with our generation of you see whatever business leader or whatever, or you hear these incredible stories of this whiz kid that was 23 that went on to, like Mark Zuckerberg.
Mm-hmm.
That's what everyone wants to be or wants to emulate something like that without realizing that like it's going to take a while for most people or, there's certain things that go differently and you can still be on a good path.
And you can be like the smartest and the best at something and doesn't mean that you're going to be at the right place or the right time. Now, if you show up every day, the chances of you being at the right place go up a lot more than if you just never show up. But, there could have been someone else who had another social media. I mean, Mark Zuckerberg didn't even come up sort of with the original idea of, Facebook. And, that's the dream of, you write a piece of code, you make an app, and then bam, collect your $1 billion and move to wherever, go to the Bahamas, somewhere fun. All right, I want to talk about this report because we were getting into a lot of good stuff, but I want to talk about multifamily a little bit. Big question. I heard there was a couple debates on LinkedIn recently, and people saying that the debates on LinkedIn, there's something. Basically, that's like, is value add dead? Because everyone has been renovating units, and it's been such a popular investment strategy. Is every unit going to have a new countertop, cabinets, LVT floors, and like it's done? There's no more value to add. And I kind of scratched my head because when I heard that, I'm like, there's been a lot of units that have, been renovated. But I've also toured a lot of properties that have been owned for 10, 15 years, and every single unit is still classic. Or a lot of projects have been bought and partially renovated. And but I didn't have really statistics of what has been done, how many units have been renovated of the total apartment stock in the U.S. And so this report from Fannie Mae, the November 22 multifamily, it's titled Multifamily Market Commentary, looking at multifamily renovations from a small but stable part of construction activity. Obviously, most of construction in terms of multifamily is new development. That makes sense. You're spending a lot of money when you're building something, not always when you're fixing up some units and curing some deferred maintenance. But they make a couple interesting points that I wanted to note. First of all, just the risk profile of a renovation project rather than a ground-up development. And Fannie Mae makes it pretty clear that renovation projects tend to be recession-proof, and that oftentimes renovation financing is available in a recession, looking back at the last great financial crisis. But also that the results tend to be pretty positive in terms of a return standpoint. One interesting statistic, and again, this answers a question on some of these LinkedIn conversations of, all right, so how many units have been renovated over the last couple of decades? And according to Fannie Mae, about 21% of all apartments over the last 2 decades have had some degree of renovation. So we're about a fifth of all multifamily properties have been renovated, which is a decent amount, but it's certainly not, it's certainly far away from saying, all right, there are no classic units to renovate. Not to mention every year these units get wear and tear. Properties where it was popular to renovate property assets built in the 60s, 70s, and 80s. Now it's the 90s and early 2000s. Whereas 5 years ago, renovating a early 2000s property seemed kind of silly because it's like, well, it's kind of still new. But now you go into these early 2000s built property up to like 2008, 2009. And they really look like a B-class property, not an A-class property. They weren't putting as high of end finishes in the early mid 2000s. They don't look fresh, they don't look modern, they look like a B-class asset. So there's clearly an opportunity in the right market, the right demographics, to do a renovation project and bring those rents closer to market and make it look like a brand new, close to a brand new asset. Because a lot of the aesthetic choices or the way that it was constructed is still modern. There's not a lot of physical obsolescence. It's just the finishes are out of date. So we've got a lot of new units that are just getting older every year that need renovation, but also a lot of classic units that have not been renovated either. We can see, I found this interesting, just the value add business plan has become more and more popular over the years, and this graph really gives us a good example of that. Really kind of after 2013, 2014, which the economy was really recovering after the great financial crisis. But you can see in the red is the renovations only. So obviously development picked up as well, but a lot more of just renovation only business plans. When we look at the previous cycle, this chart 2002 really through, it's called the great financial crisis, 2009 or so, it was a pretty small percentage of multifamily construction projects. Now, today, it's a much, much larger percentage of the overall construction. Now, when we were going through this report, Addison, I think the first thing that you asked about was the difference between the last couple of years and this last year, because we've seen two things happen. Costs have gone up, material and labor, as well as the fact that you didn't necessarily need to do a big renovation project to get the rent premium you were underwriting. Look at, okay, we're going to put in, call it, $10,000 per unit and hope to get a, $250 rent premium. Well, you could, then now the option is, you can, instead of putting $10,000 in, you have to put $15,000 in, and maybe you'll get more than the $250. Maybe you'll get like a $350 rent premium, which is great. Or you could put very little money in, maybe do a heavy turn, put in an LVT floor, or just clean a unit up, and still get a $250 rent premium. So it's a pretty easy return calculation of, $0 if you're not putting anything into it, or call it $500 to $1,000 normal turn cost divided by 250 versus 15,000 divided by 250. I mean, it's a pretty it's pretty easy. It's pretty easy math. Obviously annualized the 250. So your assumption that what happened during the pandemic? So we're seeing a big decrease in money being spent on multifamily construction, and I think it's exactly what we've talked about. Just COVID happened, so just jobs slowed down. You couldn't get the work done, and you couldn't find the people, couldn't find the materials, or it was all just too expensive. And then you're getting a higher return for doing less. So why would you just throw more money at it?
Well, I feel like there's also been a weird cycle in that in 2020 or 2021. I want to say more of the renters had the power because it was, I don't think Indianapolis experienced it as, I know they experienced it, but I wouldn't say it's probably anywhere near as much as Chicago or New York or LA of if I can work from home, or even if I can still live in Manhattan or Chicago, what's my draw when I can't go to any of the restaurants? I can't go to a sporting event.
Yeah.
So for them, there was no incentive to really, I would imagine on the landlord side or the owner side, there's really not a huge incentive to renovate stuff because you're not going to get the premiums. So a lot of people don't. There's some people leaving the renter pool because there's no point in living in the downtown areas, or you also had kind of, I don't want to say a mass exodus, but at that point with interest rates, you had people that said, now's the perfect time to buy a home.
Yeah.
And then on the flip side, I think now with where interest rates are at, how you've almost stopped people from, I shouldn't say stopped, a lot less people are in the home buying appetite, or have the less of the home buying appetite just because of how bad debt is. Now it's like, do we really need to renovate properties? Because these renters don't really have another option. They don't have anywhere to go. Yeah.
No, all good points. And we're going to let's take a look at that here real quick. The only last point I'd like to say, and maybe another reason is, outside of things were expensive, and you're getting a premium, people also weren't moving around much in 2020, 2021. So it's like not like you even had the units to renovate. You have to have someone not living there, unless you're going to do an in-place rapid reno, which is something that you could do. It's expensive to do. But, we were at so many properties here at 90, 100% occupied. Even if you wanted to renovate every unit, they're not happening. They're not turning over. The people are renewing. Renewal rates were 60+%. So,
and I don't know if there's going to be the study on it, because I think a lot of it would be anecdotal. But I don't live where I live because the countertops are flawless, or the appliances are just too hard to pass up. It's more of a location and I don't want to say kind of a lifestyle choice, but in some cases I do wonder, like, you can do the renovations, but is that really going to move the needle in any way? On kind of what your renter pool is.
So it's more. So what would you? So you live in an apartment right now, downtown Indianapolis. Is it location? It's number one.
A little bit of location.
Or what's of interest to you when you're looking at an apartment to live in?
A lot of it was location. A lot of it was what am I going to be near in terms of, one, do I really? I'm not interested in giving myself a longer commute to work than I need.
Yeah.
But also, where do friends live at, or stuff that I would be interested in doing? Am I going to be close to that or far away from that? I mean, for example, I don't do anything up in Carmel or know anyone up in Carmel, so it wouldn't really make sense to just live near Carmel for no reason, or live in it.
Just give it a couple of years. So on that though, just while we have you, so you live downtown. Other conversation, debate, post-pandemic, death of the city, death of downtown, crime, homelessness, scary, riots, all. No one's ever going to go downtown again. What was narrative, and you still hear it from people who haven't been back downtown in 2 years.
That have lived in the suburbs for the last 30 years as well.
Exactly. So on one hand, downtown's not fully recovered, and things I would say have, they're better than they were maybe a year or so ago, but they're like not better than maybe pre-pandemic. What are your thoughts on the future of kind of the urban core in the city? Are young people still driven to the urban core? Do you like living downtown?
I do. I mean, I'm almost convinced that I could, even into my 30s or 40s, no matter what the city would be, I would probably still want to live in the city. I've never bought the whole downtowns are going, they're going existent or whatever. I think a lot of it is, I mean, there's going to be concerns about crime, and I don't think that that's more of a COVID thing. I think that's more just, cities are going through a weird phase and they're going to have to figure that out. But for people my age, I don't think that there's going to be any other competitive draw of, okay, I would rather live in Carmel and commute everywhere all the time. It's mainly where your friends are going. I mean, I know from Ohio State, people were either staying in Columbus or going to Chicago. And when they were moving to those places, they were living.
Where are my friends going?
And they weren't exactly downtown, but I mean, that's where they'd go when they had free time. So, I mean, on an anecdotal point, I haven't heard that stopping, but I think where a lot of the end of the downtown spree has come from is just during COVID.
When you couldn't do anything downtown. Well, it was your friends weren't downtown anymore.
Well, you
weren't working downtown. But what? Yeah,
and I think you had a lot of people that graduated college. That would be the fresh, I don't want to say batch of people that would have come in, but there was a stoppage of people coming in because there was just no point in paying that rent if you didn't have to. Especially if you're working remote. And then you had people that were either kind of nudged to leave because of what was going on, or people that were already going to hit that phase anyway because their families got bigger. There's just nothing to replace them.
Yeah.
And so I think that's yet another kind of correction that's taking place.
If you're buying a multifamily apartment, would you buy downtown or suburban? Obviously, it depends on the deal, but just generally right now.
Depending on the type of property, I would be very interested in doing downtown.
Yeah.
The tough part is with a lot of them now, is that you're seeing some places that are now mixing with office and apartment and retail on the bottom. That I don't know,
Complicates financing.
if you're putting that up with a suburban complex that's just apartments.
Yeah.
Pure
Pure
handle.
apartments. Yeah. So do you think that there's an opportunity maybe for some of these downtown assets that just downtown's lost favor, all the focus is on the suburbs, and you might be able to pick up a good deal? Think that's the opportunity, or do you think that there's some long-term growth prospects that we're just missing in the cities? Because there was a big trend back to the cities over the last decade, and so the question is, are we, is it back? We're reversing that right now. So over the next 10 years,
The tough part with it is it's hard to kind of separate. Is this a real estate trend or is this just something going on with the city? Because I would say since 2010, Indianapolis has done a lot more investment into the city, trying to bring stuff into the downtown that I could see how in 2005 it wasn't worth living in downtown Indianapolis, where now it is.
yeah,
I do think that there's an opportunity to be had there, but I would almost tend to think it's more so, how do you keep people interested when after 5 or 6 years of living downtown, I still have to park my car in a garage, or I don't have a parking space, or it's really hard to go get groceries or stuff like that. How do you keep people from kind of breaking that cycle and staying? But I still think that recent college grads are always going to go downtown.
Yeah, I agree with you. I think that the biggest thing is just when people start to kind of settle down, whether that's long-term boyfriend, girlfriend, getting married, or having kids, like along the path. Some people, it's like they get married, they move out to the suburbs. Some people, it's like they have kids and they stay downtown. But if you're going to make that switch, I feel like it's one of those life events, and also a switch from becoming a renter to a homeowner, as well as just kind of those major life events. But I know quite a few people that were like all about downtown, living in the city or like near the city, or not necessarily downtown, but not in the suburbs, and then have kids. A year or so later, they're like, we just need some space. And that's where the homes are available. Also, if you want to buy something, like it's hard to find something with space that's not falling apart sometimes, kind of in the city, unless you want to put a lot of money into it. And just the suburbs are kind of like the easy button, and you've got a couple kids running around. It's like, just press it. It's fine.
But on the flip side, I would also say
that doesn't make sense to you right now.
Well, the way I look at it is like, there's no, I guess to me, I don't want to say there's any added benefit, but at this point, there's really not a difference or desire of like, I need to live in an apartment versus need to live in a house. But I do know I'm not ready to take care of a broken water tank. After work, I'm not necessarily going to be fully in the mood of like, I need to cut the grass, or I need to plow the driveway because I can't get to work.
So that was one of my next questions. So what not necessarily, how do you feel about home ownership right now, but more of just like the concept, like in general, like in your mind, will you buy a home at some point, or is that a question at all?
Yeah, I don't have any qualms with home buying, and I would not be surprised if I bought a home at some point. Before I pass, but
at some point in your life.
I think
you're like, I do work in real estate. At some point, it might be nice to.
Well, I think the thing that was kind of nice about growing up in or being alive, old enough, I guess, during the financial crisis and seeing the stuff that came out afterwards, like Big Short and everything, was, for me, there was no, like, I view home ownership as something that would be nice, but it's not an American dream thing to me. Because it's like, I can either pay $1,200 a month in rent or $1,300 a month in a mortgage. It's the same thing. So At least, to me, it is on top of now I got to cut the grass. Now I'm required, like, there's a bunch of utilities that then come on my plate that I think for our generation, there's a lot of stuff that when it comes to home ownership, it's just viewed differently.
Yeah.
Not necessarily in a positive or negative light, but just, I don't need to own a home.
Yeah. If you take if you can remove like the sense of like pride, I guess, out of the equation, and you look at like what are the true like benefits versus like the risks between renting and buying, it becomes harder and harder to justify buying. Because like, what do you really, really get out of it? Because you never like, it's not like, oh, well, I've never had to pay anything, I can never have to worry about it. It's like, no, you still, like, if you don't pay your property taxes, like, if you can own your property free and clear, not have a mortgage on it, you don't pay your property taxes, the government's going to come in and take your property. So like, you always have some ongoing financial responsibility and liability, not to mention if you want to upkeep the property as well. And so it's like, what are the real advantages? It's not, you can't just set and forget it and not pay. So there's always financial liability. But the advantages are, you can do what you want to it. You can paint it. You want to paint it a different color, you can paint a different color. You don't have to worry about like, you want to knock a wall down, you can knock a wall down. But like, how many people paint their house a different color? How many people knock a wall down? How many people really care? And all those things, you might be able to get, if it's a rental home, maybe your landlord may do that for, an extra $100, a month or so, on the rent, or $200, a lot cheaper than the like 15, 20,000 you're going to have to shell out to actually do the work itself. So it's like, and I think about like, what are the real advantages? Okay, I know I'm going to be able to live here because what if they don't offer to like renew my lease or something? But other than that, like, there's nothing really that owning your own home does for you, that renting wouldn't.
Well, and I kind of laugh how you're talking about like you can paint your house a certain color, knock down a wall, and it's like an HOA can still block that.
Yeah, exactly. And you still have to technically ask permission, whether it's HOA or pulling permits. And then the reason why people have done it and it's such an idea and bundled into this American dream is the ability to, build equity over time and grow wealth, which I think that's great. And it has proven to be an excellent, kind of savings vehicle, like a forced savings plan and a forced investment plan. And that has benefited a lot of people without a doubt. But then my issue with that is it's the largest purchase and investment typically someone has. And how often does that largest purchase that individual is going to make, that's got to line up with all the things you want out of a home, which are not related to finance or making money. It's like an aesthetic choice based on your family and how you want to live your life. It has nothing to do with like, are we going to make money off this house? But then it needs to align with that ability to like make money over time and appreciate, which maybe it will. Statistically, it should. But is it the best investment vehicle?
Well, I don't want to say there's a slight disagreement there, but I remember reading one of the books in the office that was like the Wall Street Journal Real Estate Investment Guide or whatever, and the author, and it was a big thing of unless you're owning multiple homes and you're flipping them, or you own one home and then you own 3 others that you rent out, buying a home is not going to make you money. Like you buy your forever home, you're going to lose money on it because like if all you factor in is, well, I paid $300,000 and then 30 years later I sold it for $600,000, then you're right, you made money, but you're not factoring in all the property taxes you paid, all the renovations you paid, all the maintenance,
everything
and stuff like that. That he's like, you're going to lose money on it.
Maybe you're breaking even,
right?
Yeah, you're not really No, I don't disagree, but people think of it as I bought it at 300 and sold it at 600. That's all they think about, and so I think just it's being decoupled, the idea of the American dream, and it's got to be a 30-year fixed mortgage, and if you've got the money, like what if individuals, when they were at a point in their life where they had enough money for a down payment, whether that's 3% down or 20% down, instead of saying like, okay, let's buy a house, let's go buy a house, because like we're at the time of our lives where we should buy a house. What if people were thinking about what kind of an investment can I make with this nest egg? How will this investment put me in a good position over the next 5, 10, 15, 20, 30 years? And maybe that is a house. But I don't think if you look at it unemotionally and just from the numbers, it's probably not going to be a house. It might be, an index fund. It might be an investment in another type of real estate. You might buy a duplex and rent them both out and rent somewhere else. Or maybe it is house hacking. Maybe that can align with your investment goals and how you want to live.
Well, the other issue that I thought about this after the first or second time I saw The Big Short. How many things do we do as a broader, like global society, or just as Americans, that we do instinctively because that's either what our parents did or that's just conventional wisdom? And conventional wisdom at the time was you rack up the 10 or 20% down payment you need, you buy a house, you're good to go. I would have to imagine that in my parents' generation, it was frowned upon to have like rented a house.
Mm-hmm. Yeah, you're not seen. Yeah, it's seen as unbecoming. Lesser.
I mean, yeah, I've heard plenty of times people like, oh, they're the renters.
They're still renting.
As if it's like,
transients,
violent,
vagabonds.
Yeah. And it's like, they're kind of doing the same thing you are. Like, you miss mortgage payments, the bank takes your house. You miss rent payments, tenant evicts them, or landlord evicts them. What's the difference? Yeah. And also, I don't know, I'd be curious to see in 20, 30, 40 years, I'm sure it's even happening now, if that theory of getting a down payment and buying a house is even a thing, when I'm sure if you ask a lot of 20-year-olds what would be more important to them is getting rid of student loans. Or I'm sure there's some kids now where it's, I can either save up for a down payment on our house or I could finally own my own car. Yeah. And I need a car every day to get to work.
Yeah. Car's probably worse investment though.
Definitely.
Yeah, for sure. But
I've seen enough Dave Ramsey videos.
Yeah. He's got a new car. What kind of car is that? All right, this last piece, because we're running along, but this is really good stuff. We're getting some insight because Addison, you and your age group, plus or minus, it's like core renter demographic, and people need to be thinking about putting a business plan together. Who you are renting to, what do they want? What are they looking for, and not just. It needs to be kind of a clean place and we'll slap a countertop on. We're done with it. Okay, last piece. We're talking about home ownership. We're going to finally get into the piece. Freddie Mac, do rising interest rates price out mortgage-ready borrowers? Spoiler alert, yes, absolutely. But it's more of how many people have been priced out. Because again, earlier in the year, we had rates that were around 3% in early 22. Now we are over 7% as of early November. Rates not seen this high since the 1980s, as they have doubled. But so by the numbers, what does this look like? I'm just going to scroll down here right now. There's a couple of graphs and some tables. Okay, millions of people in these different color lines that I can't tell which color is which, because I'm colorblind, are your mortgage, and how many more borrowers are there going to be or less based on what the interest rate on that mortgage is. As you can see, I mean, all price bands, income bands have decreased quite a bit. I mean, at the top, so the $200,000 mortgage. Most folks could afford that back when 3%, back when interest rates were 3%, about 40 million people, just under 40 million people. That's a lot of Americans could qualify for a $200,000 mortgage. Now today, today when say rates are close to 7%, that number is under 35 million. And if they get up to 8%, it's going to be close to 30 million. That's a pretty big move. And in general, across the spectrum, I mean, in the, what is this? What color is this? Is the 600K?
Yeah.
This, what color is this? What color is that?
Yellow.
Yeah. That's yellow.
Uh-huh.
What's this? What's this one?
Light green.
Okay. The yellow, the burnt yellow on the bottom. That's the 600,000. That's the price use mortgage. It was about 12.5 million folks in the United States could afford a mortgage. Now we are closer to 2.5. So it's essentially been That's been cut quite a bit. This table down here, this kind of really shows it more in aggregate, though. At 4%, there were 22 million home buyers out there. That's a lot of home buyers. At 5%, goes down to 18 million. At 7 million, we're at 12 million home buyers. So we've basically taken out 10 million home buyers from the pool. It's essentially cut in half. And so in terms of multifamily and rentals, these are all folks that, or not all, but a large chunk of these individuals we were expecting to buy a home at some point, because they're at the age, they're forming a family, they're getting married, they're having kids, they want to move out to the suburbs. Time to buy a house, because it's this American culture and following the American dream. What other demographics, what other generations have done in the past, less and less each time. It's been stretched out longer. The great financial crisis, pushed out millennials getting married, moving out on their own, having kids, and COVID only, further pushed that out. This is only pushing out even further. We haven't built enough housing supply in general. And we thought we were going to get some relief in the lease apartment world with people going out and moving to single family homes. That's not going to be necessarily the case for the foreseeable future. That means there's even more apartment units that we're going to need over the next 5 years than we had originally anticipated. So to me, that's makes the housing crisis even worse. It's going to lead to higher occupancy, higher rent growth over time, especially in these income bands that almost could afford to buy a home. And so these are the folks that probably are going to be in your B plus, A class communities, which Matt Bossong and I were looking last week. So many of these people were in the renters by choice category. They are all now in the renters by necessity category.
Yep.
And so it's interesting, like rent growth in the renters by necessity category has increased recently.
Okay.
But it's not necessarily because like the same apartments and same renters who were renters by necessity have grown rents and incomes. It's just that there's a much larger pool of people being considered renters by necessity, and their rent is higher and their incomes are higher. So it kind of skews the data a little bit.
Yeah, it's interesting to think about how the interest rates goes up, people get priced out, but also as you kind of mentioned, I think a lot of it. As you mentioned, in terms of housing supply, I think the situation's also going to continue to get worse in the sense that I feel like there's less opposition to building homes than there is apartments.
Yeah.
And kind of that, phobia or whatever that I mentioned earlier of like renters. It seems like whenever someone wants to build an apartment complex, even if it's not affordable housing, there's opposition of it's going to make home values go down. It's going to mess up the demographics of the area.
And people say, we need to build housing, and just maybe not this right here.
Yeah.
It's like, okay, that's not very helpful. Surprisingly, the multifamily permits have stayed pretty strong even as of recently, but it's just the deliveries just are not showing up. It's taking longer to get things built and actually leased up and occupied. The supply is coming, not enough supply. And the supply is just so concentrated in the Sun Belt and primary markets. Yeah. And so you got a lot of the country that is growing, but just not getting the apartments that we need.
And that's kind of the, I don't know if it's a product of it's really affecting people due to the last, kind of the current events that have happened in the last 2 years, or if it's more of a product of because there's been more and more technology, more and more social media that people have access to information.
Yeah.
But it seems like now more than ever, housing supply has become a big issue, and it's not just towards one party or another. I remember reading an op-ed a few weeks ago in the New York Times about Los Angeles' issue. Yeah. And it's become big enough now that it's kind of enveloped Gavin Newsom to say, like, that we've got to figure something out. Like, this can't be we can't kick the can down the road.
Yeah.
I'm kind of, even Chicago's getting pretty creative of, all right, people don't want to use these office buildings, so we'll incentivize builders to come in, flip them to apartments, and get stuff moving that way.
Yeah. So there's so many layers to the onion, but it's definitely over the last couple of years been much more at the forefront. Starting the pandemic and the whole eviction tsunami talk and the eviction moratorium, and then followed by rent increases that were quite a bit. But surprisingly, when you look at rent to income ratios are kind of still within line.
It's interesting to hear, whether it be through friends or stories in newspapers now or whatever, of kind of the push for rent controls or certain, I don't want to say issues with rent, but kind of what I had mentioned earlier of how much is the home buyer pool going to shrink years down the line when it continues to be more of, I have student loans and stuff I got to pay off.
Yeah.
How many people are then continuing to stay as renters because of those things?
Yeah.
And they're never going to be able to make that natural movement. How is that affecting the housing supply? Because you have a permanent pool of renters that aren't going to go anywhere because, as you said, they're renting by necessity.
Yeah. Yeah. Great insights. Addison, thanks for being on the Gray Report.
Thank you for having me.
Absolutely. Love to have you back on. Maybe we can do a little you, Matty, and I. We can really kind of get into it. Matt can lead the way on some of the articles and get your insight. It's really good stuff. So Addison Lubert, again, he's the analyst over here at Gray Capital. Looks at a lot of different deals. Addison, do you want anyone to get in touch with you? Or if someone's a broker and they want to send you a deal, what's the best way to get a hold of you?
You can find me on LinkedIn at Addison Lubert, and then Addison at graycapitalllc.com is my email.
So if you're a broker, so what are you looking for? So the broker, we a lot of brokers watch this. What are we looking for right now?
I'd say anything that was built 1980s or later, primarily.
It's got to be a smoking hot deal, right?
Yeah,
It's only good deals, no bad deals, positive leverage, good cash flow. Ideally, we want the seller to be very desperate.
Yeah, 100, 150 units is good. And
Yep.
Whatever the whisper price is, if you're willing to settle for like half that, then we would be.
We can get an LOI over today. All right, guys, make sure you subscribe to the Gray Capital YouTube channel. If you're at all interested in learning more about investing with us, the Gray Fund, accredited investors only, you can go to gray.fund. Love to have a conversation with you all about that. Make sure you're signed up for the Gray Report newsletter. Addison, you may know this. It's the #1 rated multifamily intelligence aggregator and newsletter in the world.
So you're like the real estate drudge report.
Yes. But for multifamily.
Nice.
Also real estate in the economy. The newsletter, always the best, always ranked the best. #1. Everyone loves it. It's great. GrayReport.com, also wonderful. Higher frequency, a little less curation. But the newsletter is like top of all the lists. The best of lists. You've seen those?
I have.
Yeah, it's on the top of everyone. Of the best of all of everything.
Future award winner, some say.
Future. It's won all of the awards.
Okay.
The award, it's award winning. We jest, but only lightly, because it's a great newsletter. The team does a great job. Props to Matt Bosnagel for keeping the trains running on time on the Gray Report newsletter. Catch you next week. Again, subscribe, leave a comment. If you want to see Addison come back, you need to put in the comment, because without the comment, it may not happen, unfortunately. So leave a comment, subscribe, and also like, because if the video that you're on, Addison, if this gets a lot of likes, then that's also good. It's good market information, good market signals.
Yeah, I'm hoping this episode breaks records.
That's what I'm saying. If it's these videos, we've got some that have, more than others, but but however, there's no reason this video will get at least 100 views, probably 200 over time, at least. I saying 200,000, 200 million, that's up for the viewer to decide. But if all of those viewers just gave a like and made a comment, Addison's on top.
Well, and I'm a 10Xer, so I'm sure that's just gonna.
Yeah. And I know Addison's yearly bonus may or may not be dependent on it. I don't know. I'm not saying one way or the other, but it would definitely move the needle. All right, everybody. Hope you have a great Thanksgiving holiday. Let us know in the comments how you're doing your turkey. Are you deep frying? Are you smoking? Are you wet brine, dry brine? We want to hear all the turkey talk. We actually did some due diligence on a turkey establishment in Michigan recently, Turkeyville. Didn't know it existed. Matt stopped off the road. I said, let's go to Culver's. I looked down. I looked up, we're at Turkeyville. The only thing in the menu is turkey. They got about 15 entrees, all turkey, different types of turkey. A lot of turkey options, nothing else.
Did you guys double down on that, or did you get back in the car and put a call?
So I was a little upset. I wasn't upset. I was like, Matt, why are we at Turkeyville?
Mm-hmm.
Because it's like, I was like, we had a long drive back home from Michigan. Like, let's keep moving. Let's just go to the drive-thru. When we pull off, we go into this like cafeteria type setting. They have a dinner theater going on. Again, turkey themed all year round, Turkeyville. And I was pretty hungry. It was gonna be like kind of a lunch and dinner type thing, and only turkey on the menu. I'm not anti-turkey by any means, but variety is the spice of life, and I wasn't necessarily ready to make a full commitment on turkey. And but I went with the turkey club sandwich because it seemed like a safe. I wasn't ready for mashed potatoes and gravy just yet.
Mm-hmm.
Matt got the turkey grilled cheese. The turkey club was delicious. It was chef's kiss. Anyway, well, we've gone way past what we've supposed. If you were still watching the Great Report, we thank you for your service and your dedication and faith, and our apologies as well. Have a good one. Make sure you leave those comments and give us a like, because we'd love to post them on our Slack about Addison. That'd be great.
My bonus depends on it.
You heard it. All right. Have a good one. See you next week.